This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And very good afternoon, everybody. We are just moments away, 30 seconds to be exact, from the latest minutes from the last Fed decision. That was in October 28th, 29th, that two-day meeting that led to a decision where we saw another quarter of a point decrease, but we did get two dissents, Tim.
We did. We'll be looking for clues in there about what exactly led to those two dissents, and also, of course, any preview of what we can expect in December. But fair to say a lot has happened since that meeting, and that meeting on December 10th, Carol.
Yes, indeed. So just moments away, we're going to head to D.C. and our own McKee. He has the Fed Minutes.
Well, the minutes show no surprise that there was a very divided Fed at the last meeting. Some thought that inflation was going to rise too high. Some thought that unemployment rise too high, and nobody could agree on what to do at the December meeting. In general, they agreed that inflation had moved up, the economy was expanding at a moderate pace, and the unemployment rate remained low. But they did not agree on the outlook. Several said that inflation ex tariffs was close to target, but many noted inflation had been above target for quite some time and showed little sign of returning to target. Several pointed to the persistence in core non-housing services as an inflation worry, as well as additional tariff-related inflation in core goods. Quote, several participants remarked that businesses, including those not directly affected by tariffs, indicated they plan to raise prices gradually in response to higher tariff-related input costs. At the same time, a few suggested AI-related productivity gains might help keep profit margins in line, limiting the pass-through of tariff costs. A few thought the softening labor market would keep prices in check, as would recent changes in immigration. A couple said in general, officials saw elevated risks to the labor market, a few noting the impact on groups historically more sensitive to economic cycles, and some noting the apparent divergence between the subdued job growth we'd seen and the relatively strong GDP. A few saw a risk that trade tensions could weigh on economic activity. And the minutes say, against this backdrop, many participants were in favor of lowering the target range for the federal funds rate at that meeting. Some supported such a decision, but could have also supported maintaining the level of the target range, and several were against lowering the target range. In discussing the near-term course of monetary policy, participants expressed strongly differing views about what the policy decision would be that would be most likely appropriate at the committee's December meeting. In other words, guys, everything we thought we knew, the minutes basically confirm. They didn't know what was going to happen with the economy, and they are pretty divided over that.
All right, Mike, hang on for a second. We're going to come back to you in just a moment. I'm looking at markets right now. We are seeing a slight blip up when it comes to Treasury yields. Right now, I'm looking at a 2-year with a yield of 3.57, so slightly to the upside here. 5-year note with a yield of 3.68, and I'm looking at the longer end of the yield curve here in the U.S., 4.1% on that 10-year note. But again, a little bit of a blip up, and that's got to be on that headline of many saw a December rate cut as likely not appropriate. Meantime, to the equity markets, of course, a big focus of the equity markets, Nvidia earnings after the closing bell. Right now, equity markets look little changed after those Fed minutes. Right now, up 1/3 on the S&P 500, Tim, and you've got the NASDAQ 100. Same percentage gain, 1/3.
Hey, Mike, the words many and several come up a few times here to describe the number of Fed members who thought one thing or thought another thing. How can we translate those into actual numbers, many versus several?
Well, there is a whole code, actually, that the Fed has published on this, and you can find it on the Fed's website. Many means almost all, while several means two. A few means two or less, and there's always the idea that one participant said, and obviously in this set of minutes, one participant was Stephen Meier, who wanted to vote for a 50 basis point cut.
You know, it's funny. It sounds like a parent, you know, honey, I said you could go to a few parties, not many parties or several parties. Stu, come on in on this in terms of the Fed minutes. Anything that jumps out for you?
The thing that actually jumps out at me is what's been redheaded on the terminal. Many see a December rate cut as likely not appropriate. Now, even before this was, the minutes were released, markets were already fading the probability of a rate cut. About 12 basis points of a cut were priced in earlier this morning. That had fallen down to about 8 basis points of cuts priced in for December. That was on the back of the Bureau of Labor Statistics deciding not to release the October jobs report in advance of this December meeting. So folks are basically looking out at the Bureau of Labor Statistics and saying what would have been a bad jobs report is not going to be available for the Fed to make its decision. So there's going to be one fewer data print encouraging a rate cut. Now we're seeing as early as October, many committee members were ready to take that December cut off the table. If we were to rewind the clock back to September, it really was a knife edge sort of distribution when we looked at the dot plot for just this year. It was very close to half of FOMC participants saw fewer than 75 basis points. They saw about 50 and fewer cuts this year, 50 and fewer basis points of cuts this year. So this should not be shocking to see most FOMC members taking that additional rate cut off the table when we look at the minutes.
That, of course, was Bloomberg Economics U.S. and Canada economist Stuart Paul right here in our New York studio. Mike, back to you in D.C. You know, is the Fed, with the government closed, now reopening, but data, yes, coming, but not coming, are they not going to have really a full picture, enough data to really clearly figure out what's going on in the economy, or will they kind of have a good idea come December?
Well, they talked about that a little bit in the minutes. They suggested that not having the data in October was something of a problem, but they also said we have enough alternative data that we have a pretty good idea of what's going on in the economy. And I imagine that would hold true through the December 10th meeting, although we just found out we're not getting any jobs data until that's over. I wanted to note one thing. Stuart's absolutely correct about the many participants thought that a December move wasn't necessary, but that's not the end of Fed loosening. The minutes go on to say that they think, the many participants think that there is reason to keep cutting one or two more times next year and try to get back closer to neutral, but not necessarily in December. And of course, Fed officials have always chafed at the idea that we have to figure out how many rate cuts there are going to be before the end of the year. They don't look at it that way. It's just an ongoing process.
But Stuart, on that point about December, if we just focus on December, hasn't a lot changed in terms of the labor market between the end of October and where we are right now? Not officially, but the alternative data points that could actually cause members of the Fed to say, wait a second, we should do some loosening here?
Well, so it's interesting. We built a composite index that looks at all of the available alternative data. So we're not depending on the Fed to gauge how tight or how loose the labor market is right now. And when we look at that index, the current labor market is about 1 standard deviation weaker than it has been historically. That's been just a persistent weakness that's been evident in this alternative data set, just a broad swath of about a few dozen alternative indicators. And if the Fed is looking at that and is really nervous about how close they are to a neutral rate, then it makes sense that they could decide to stay on hold in December. They go, nothing has really changed materially. High frequency measures of layoffs are showing pretty close, 220 to 230, 235, 235,000 layoffs on a weekly basis when we look at the state level data. Not a material change to the best of our knowledge, but just this persistent drag, this persistent weakness. And again, Fed members are trying to remind folks that they are devoted to the 2% inflation target when we expect inflation to remain pretty close to 3% out through 2026. They need to stay, pretty measured and pretty deliberate when they make rate cut decisions.
Right. If they stick to that 2% target, we're running at 3%, then inflation's still a problem. Stuart, sit tight for a second. Mike, last question to you, though, before we let you go. 30 seconds. So what is the next thing that you are kind of keeping a watch on that might be important for the Federal Reserve before that December meeting?
Well, we're going to be looking at the September jobs report tomorrow morning. It's old, but it is maybe the last jobs report that we get before the Fed meeting that has a complete set of data. So there will be some reason to look at that as Fed officials and economists try to impute what that means for the future. We're still waiting to see what happens with the inflation numbers, the CPI. That hasn't been announced yet. If they get that in before the Fed meeting, that would be great news for Fed officials. But then you have to look to the meeting itself. Remember, the blackout period, this is an earlier Fed meeting. The blackout period starts December 1st, and we do Thanksgiving week next week, and so there won't be a whole lot of Fed speak, so we're kind of getting down to it at this point.
Just around the corner. Yeah, that's interesting. Hey, Mike, thank you so much. Good to have Mike back with us. He's been on the road. We'll hear more about that in the days to come.
He didn't forget about us, did he?
No, I don't think he forgot about us.
All right.
All right, Michael McKee, Bloomberg News, international economics and policy correspondent there in D.C. Hey, Stu, before we wrap up, you know the Bloomberg New Economy Forum is underway. Lots of global leaders in government, business, and all that good stuff. You guys on the economics team came out with a special report called Scenarios for a World in Transition. You were kind enough to share it with us. Tell us about this and if there were some conclusions or narrative that you guys came away with.
It's really interesting that the forum and this entire conference is kicking off on an FOMC minutes day, and on a day we're actually hearing additional rhetoric from the president, adding pressure on the Fed to cut rates. We go to great lengths to really consider the effects in which changing policy is driving economics and driving economic decisions. In our special report, we go through a way of quantifying whether political rhetoric is supporting or creating some sort of a deterioration in Fed independence, or is corrosive of Fed independence. And in our quantification, we found that the current rhetoric is about 20 times as bad as it has ever been, at least going back for about 30 years. So it's actually a really interesting quantification. When we think about what that could mean for rates, well, it looks like if the Fed were to be pressured into maintaining a focus on a maximum employment aspect of its dual mandate, inflation would stay close to 3%, not just through 2026, but those additional cuts as a consequence of political pressure would keep inflation around 3% through 2028. When we think about the cost of funding the national debt, when we think about the debt trajectory, it's real material consequences. These are all topics that are on discussion during this conference.
We're just fascinated to see Kevin Hassett talking with our own Anna Wong today, talking about the possibility for tariff rebate checks next year, which just create more liquidity in the system. But you do think about the government debt at the same time. Like, I just don't quite understand it.
Tariffs were offered as one of the ways to pay down the national debt, an additional 1 percentage point of GDP showing up as revenue coming from tariffs. If those end up just going right back out in the form of checks to lower income households, not only is it not paying down the national debt, but it's creating some of those inflation pressures that we saw as a consequence of stimulus during COVID.
Hey, before we let you go, we're going to be speaking to Mandeep Singh in just a minute about Nvidia and the promise, of course, of productivity when it comes to this technology. How are you quantifying that?
Well, do you have a little product, AI robot helping you at all?
We do. We, of course, have, the tools available on the terminal that are deploying large language models that are super helpful and encourage folks to dig into some of those available tools. But when we look broadly at the macroeconomic data, it's actually really difficult so far to find evidence of productivity gains. It looks like productivity gains from AI is just hovering around 10 basis points of additional growth per year. When we look at certain industries, however, there is a lot of evidence. So the IT industry, information, computer coding, real GDP in the information industry has increased about 25% since before the COVID period, but employment in the industry has increased just about 1%. So there are gains in productivity, but they seem to be pretty concentrated for now. The biggest macro indicator is, of course, Nvidia earnings. So I'm looking forward to hearing what Mandeep has to say and looking forward to what's going on after the close.
He's passing the baton. I love it. Stu, thank you so much. Bloomberg Economics U.S. and Canada economist Stuart Paul. All right, as he said, Nvidia definitely top of mind. The stock is up about 2.1% here ahead of earnings. It's the king of, I feel like, all the AI bellwethers that are out there, and their earnings do get released today later on.
So let's bring in Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh. 4:20 p.m. Wall Street time is when we are expecting those numbers. The numbers, the expectations, those are certainly one thing. The commentary, though, what's important when it comes to the commentary?
I mean, look, what got Nvidia here in terms of getting to a $200 billion data center business is it was a virtual monopoly when it comes to training of these LLMs. And even with inferencing, they had the majority of share. Even though AMD had a chip out there, Intel kept talking about GPUs, it was all along Nvidia. Now, what changed yesterday was Google telling us they trained Gemini 3 entirely on TPUs. They are using TPUs, their own chips for inferencing. And so to my mind, it's now a duopoly in terms of at least enterprises having an option to use Google TPUs. And even OpenAI has a deal with AMD, 6 gigawatts, which is sizable. So what OpenAI is saying is there is a third option where you can run large language models on AMD. So from that perspective, I feel like there are 3 players now, but this market is also expanding. So it's not as if, you have to divvy up the same share across 3 players. The market is still growing 40% because the CapEx numbers are growing 40% plus next year.
Yeah, I was looking at our Markets Live blog earlier today, Mandeep, and they said in most recent quarters, Nvidia earnings heralded broad price declines as traders took profits. But they said this time AI stocks have been sliding since the end of October, so the earnings announcement may even provoke buying. So if we just see even a tinge of optimism, could we possibly, I know you don't tout stocks or look at stocks, but if we have any more optimism coming from Jensen and team, could we see kind of everyone come back into that AI trade?
I mean, right now, the real big constraint is power. And every big company has validated that. And you want to optimize the power available to you with the best chips. And that's Jensen's pitch is we are pushing the
energy efficient, essentially?
Most energy efficient chip. That's where the Blackwell shipments are really important because you want the print to say that Blackwell is what drove the beat and raise. And customers are looking to refresh their chips, even if it's a 2-year cycle and they have to take a hit on depreciation, they still want Blackwell because it's more power efficient and more performance per chip.
On the power side of this, we learned today the U.S. government plans to buy and own as many as 10 new large nuclear reactors that could be paid for using Japan's $550 billion funding pledge, part of a push to meet surging demand for electricity. These take so long to build, so long to get back online. Is it even on your radar when it comes to what you're doing in Excel right now?
I mean, look, they've told us that they want to add, OpenAI wants to add 26 gigawatt. Every hyperscaler who has a $100 billion budget is looking to add at least 2 gigawatts of power. And I'm working with that equation. 1 gigawatt is like almost $50 billion in spend. And out of that, 25 to 30 billion right now is going to Nvidia because that's the bulk of what goes inside a data center. But if you are using a TPU, a Google TPU, that 25 to 30 billion goes down to 15 to 20 billion because Google doesn't have to pay the Nvidia chip premium, the 75% gross margins. So that's where, if you're looking to diversify, and look, that's what, when people are talking about circular financing, that's Nvidia's way of lowering their price. They don't want to take a hit on their gross margin. They want to invest in Anthropic and OpenAI and say, look, guys, we want to give you a discount to remain part of our ecosystem. But instead of lowering our chip prices, we are investing this amount in you. So it sort of subsidizes. And I think that's their way of lowering the price and getting to that TPU sort of range where the arbitrage is very clear. Google TPUs are much cheaper when you are setting a 1 gigawatt data center.
So it makes sense. Isn't worrisome.
I think so.
All right. Thank you. Thank you. Mandeep Singh, we know we'll be focusing on him. Nvidia. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow Jones Industrial Average back in the red. Been a choppy day. The Dow now lower. S&P, NASDAQ higher ahead of Nvidia earnings after the closing bell. Going to be all over those Nvidia numbers as they break on Bloomberg television and radio. Bottom line here, stocks snapping back with the S&P up 0.2%. Higher by 11 right now with the S&P at 66.27. Dow Industrials, though, lower, down 57. Drop there of 0.1%. The NASDAQ Composite Index up 73. That is a gain of 0.3%. And our Mag 7 Index higher now by 0.6%. 10-year, 4.10% with the 2-year, 3.57%. Spot gold up 0.2%, 4,075 the ounce. West Texas Intermediate crude down 2.1%, 59.47 a barrel. Bitcoin, major sell-off again today with an 88,000 handle now on Bitcoin, 88,955. Bitcoin down by 3.8%. Nvidia ahead of earnings up now by 2%. After earnings, Lowe's, the home improvement retailer, up 5.2%. Rival Home Depot down another 0.8%. So again, recapping, stocks edging higher. S&P up 0.1% ahead of Nvidia after the bell. Nvidia right now up by 2%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Carol Massar along with Tim Stenovec live here on Bloomberg Businessweek Daily here from Bloomberg headquarters in New York City. Hey, it was just about 1 month ago that investors spooked by the implosion of auto lender Tricolor Holdings and car part supplier First Brands Group got little reassurance from the head of the biggest U.S. bank. It is when J.P. Morgan Chase's CEO was on the earnings call with the analysts. That CEO, Jamie Dimon, said, this is a quote, "My antenna goes up when things like that happen. I probably shouldn't say this, but when you see one cockroach, there are probably more. Everyone should be forewarned on this one."
Just an editorial note, I always like when an executive says, I probably shouldn't say this, and then says it. That means it's definitely going to be.
It's our favorite moment.
Yeah, that's definitely going to be good. Dimon and other bank leaders, offered warnings about potential troubles with lending or signs of economic weakness, despite their banks posting revenue that beat analyst estimates. Those in the private lending and credit space have counted Jamie Dimon's concerns, including Apollo CEO Mark Rowan. He spoke in a panel discussion earlier today at the Bloomberg New Economy Forum in Singapore. He downplayed recent concerns cited by Jamie Dimon that there are, quote, cockroaches in credit markets.
The size of the private credit market, as I see it, is some 41 trillion. Most of the market is investment grade. A fraction of it, some 2 trillion, is below investment grade levered lending. And so much of the focus is on this notion of levered lending and the Tricolors and the First Brands. And if you think about what's happened, the shock from tariffs has now adjusted into the economy. The shock from high rates has now adjusted into the economy. Credit stats are actually improving rather than declining. That does not mean we will not have late cycle banking behavior, because there are good banks and bad banks, and good insurance companies and bad insurance companies, and good asset managers and bad asset managers. But there's nothing that I see that is systemic.
All right, that again is Apollo CEO Mark Rowan speaking in a panel discussion earlier today at the Bloomberg New Economy Forum in Singapore. Hey, meantime today, and this is what really has got our attention as well, the investment management firm that focuses on private capital solutions like private credit, Blue Owl Capital, calling off a merger of 2 of its private credit funds after scrutiny over potential investor losses from the move sent its shares tumbling. Shares of Blue Owl, by the way, lower today. They've lost nearly 50% of their value since an all-time high in late January. So for the reasons why, what this is all about, and maybe the significance of Blue Owl as we continue to look at kind of the private credit and lending market, we bring in Sri Natarajan. He is Chief Wall Street Correspondent at Bloomberg News. He's right here in our studio. Also with us is CreditSights Global Head of Strategy, Winnie Cisar. She's with us from Charlotte, North Carolina. Winnie, we'll get to you in a moment. Sri, we want to just ask you a couple questions. Blue Owl, who are they? Where are they in the investment world, private markets, private credit world? And what's the significance of the news today?
So it's a good question. We talk a lot about Blue Owl, and Blue Owl loves to make a lot of headlines. So it is important to reorient our listeners as to what is Blue Owl and who are they. It was formed as a venture. It was a tie-up, a merger between Owl Rock and Dial. Owl Rock invested in a lot of middle market companies, say companies in the $50 to $200 million EBITDA range. They need loans. Regional banks were pulling back. They didn't necessarily have the capital easily available to them. So if there were people willing to step up and say, we're ready to do the due diligence, we're ready to do the credit work and lend to these companies, Owl Rock discovered there was a market for it. And Dial was a company that was investing in secondary stakes for a lot of these private capital firms. When you merged the two, you had the formation of Blue Owl, which in the last 4 years since the merger in the last 4 years has become sort of a proxy for the private credit market, because as the demand for such players has grown, as their capital has become far more important, and as they've been flexing their muscle, Blue Owl is certainly at the forefront of it. And the people behind Blue Owl, you have veterans from Goldman Sachs, Craig Packer, Lipschultz from KKR, you have Doug Ostrover from, erstwhile GSO/Blackstone. So these are really smart people. So when we think about the private credit market and try and get a sense of how it's doing, we look at players like Blue Owl. They have truly positioned themselves as the leaders in that space.
Well, speaking of mergers, that brings us to what happened earlier this week and why we saw shares decline. On Monday, there was set to be a merger between two of its private credit funds. Now it has called that merger off. Why in the first place would Blue Owl want to combine two of its private credit funds?
And look, it's just such a self-inflicted wound. And, truly, this isn't something extraordinary or something that never happens. A lot of their non-listed vehicles, this was a private vehicle for a lot of high net worth individuals to gain exposure into private credit markets. Eventually, as a means of getting liquidity, you either take that vehicle and take it public so that people can trade in and out of it, or over the life cycle of that fund, after its defined life ends, you just wind it down. You get the principal back. You've been paying out the interest as dividends to your shareholders. And when you get the principal back, you could wind down the fund. Now, Craig Packer was talking about it this morning as to when the idea was originally seeded. This private vehicle, OBDC2 that we're talking about, for high net worth individuals, and the public vehicle, the much larger public vehicle that does exist, OBDC.
Right.
They had a lot of overlap, and pretty much these funds had almost identical holdings, something like 98% overlap. And when they initially thought about this merger, the public vehicle was actually trading very close to its book value. So it wouldn't have mattered a whole lot. The board would have easily approved it. The shareholders would have easily approved it. But the timing, the decision to announce this just a few weeks back couldn't have been worse, because you were suddenly telling investors in a unlisted vehicle who could trade in and out of that on a quarterly basis at book value, and Blue Owl had been honoring all those redemption requests all this time, that they now move into a publicly traded vehicle.
Which is discounted, right?
Which was trading at a 20% discount. So when the FT initially reported about this, they were absolutely right. On day one, you have a 20% paper loss, and no one's going to like that. And that was the problem. And it comes at a time, and we talked about the Jamie Dimon cockroach comments. Yeah. Remember the loudest critic of Jamie Dimon right after that comment?
I forget, was it
Blue Owl. It was Lipschultz talking to our very own Danny Berger, and even without Danny mentioning Jamie Dimon, he took a swing at the big bang, saying that the next problems in private credit, next problems in the credit market are not going to be in the private credit firms. It is going to be at the banks. So with those headlines in the near past and what's happened now, it's not a good look. It is a bit of a black eye.
All right, so interesting. Winnie, thank you for your patience, because we really wanted to lay this out because we feel like it's complicated. Come in on this, and Blue Owl is one thing, but the back and forth between the private credit guys saying, hey, everything's kind of okay, it seems like, and then you still have Jamie Dimon, who is, when you think about the financial system in the United States, when he says something, you stand up and listen. We've talked with this about you before. I mean, are you starting to see some concerns? Is anything growing in terms of momentum when it comes to maybe cracks, certainly in the private world, the private credit world?
Yeah, it's really interesting. We have oftentimes dubbed the relationship between private credit and public credit, so broadly syndicated loans, high yield, kind of banks in general, as the best of frenemies. There are definitely some frictions there, but then there are a lot of very complementary factors, not to the least, the fact that a lot of the banks lend to these private credit firms. So, it's in the bank's best interest that private credit remains on a relatively stable footing as well, given that lending relationship. Now, when we zoom out a little bit and think about what has developed in private credit over the past, call it 3 to 5 years, there's been so much capital chasing not as many assets. And that oftentimes means that that competition for capital is going to result in some sort of erosion. It could be in terms of covenant quality. It could be in terms of lower pricing, which means that potential returns are a little bit lower. And I think that we're seeing some of the fallout or consequences from all of that capital inflow into private credit start to turn into some question marks about, what has actually occurred in this asset class, how many credit cockroaches are there. I think that anytime you're lending, there's going to be defaults. That's just a reality of credit as a whole. And it is also a reality that when you have a lot of capital that's flowing into one specific sector or type of asset class, you oftentimes see kind of a subsequent uptick in defaults just from that law of large numbers.
One of the criticisms of the entire private credit industry is that it's opaque, and the opacity concerns investors. They don't have the same regulatory environment that the big banks have. And I was struck what Mark Rowan of Apollo said earlier. We heard his comments there from the Bloomberg New Economy Forum in Singapore. The market's being $41 trillion. Most of the market is investment grade. He thinks a fraction of it, in his view, some $2 trillion is below investment grade levered lending. Is that sort of if you look at the pie, would you agree with how that pie is sliced?
Yeah, I think that probably the pie slice is accurate, but I think that you can't underappreciate how important that below investment grade component is, because the growth has really resulted in a tremendous support or tailwind for public left-fin markets, like broadly syndicated loans, like high yield. When we've gone through periods of public market volatility, private credit has really stepped in to absorb some of the maturities of more stressed issuers or provide pretty big checks to help keep things moving forward. And if you have a coincident move where private credit is coming under pressure and you're seeing public market volatility, that could be a setup for a much larger streak of defaults than what we've seen in recent years.
One thing Sridhar, I want to bring you back here. As you guys report this out, keep an eye on what's going on in terms of credit markets, the health of the U.S. financial industry. Who are you talking to see, where there might be some cracks in the broader market, or broader credit market, I should say?
Look, when the cycle turns, and pretty much the universal belief is at some point the cycle will turn, I think what some of the more experienced executives want to point out that it is not going to be a question of this or that. It is not going to be a question of whether it's a private market that's terrible or whether it's the lending done at big banks. You will have some cracks in the market. But private credit or big banks, it's the same lending system. People who do good diligence and who do the legwork and who understand credit will come out looking good. And people who are tourists in the sector will end up with big losses. So when we talk about private credit concerns, you should be mindful of the fact that you necessarily won't see the biggest problems at the biggest players. You shouldn't expect the Apollos and the Blackstones and the KKRs to be at the forefront of any downturn. But there are many other smaller players,
right,
and especially those who are coming into this asset class because there is so much interest in this asset class. If you can raise money for a strategy and the interest from investors is in the private credit strategy, it suddenly attracts a lot of new entrants. You have to worry about those players more than anything else.
Hey, Winnie, come on back in here. And I just want to hear from your view about exposure that traditional financial institutions have to this space. Big banks, they're often the ones who are lending money when it comes to these private credit firms. What's their exposure?
Yeah, so I think that a lot of people are trying to quantify that because there is this relationship between banks and non-bank lenders, with banks lending to the private credit industry. Now, I think in general, given how diversified big bank portfolios are, we can probably pretty safely say that this is not a kind of systemic risk looming, especially when we think of the leveraged finance component of private credit and that exposure on bank balance sheets. But within private credit, specifically, we do want to think about things like diversification of portfolios and outsized concentration risk, perhaps in lending relationships to sectors that might come under a little bit more stress in the near term. I think it's pretty well understood that there's a lot of healthcare in a lot of private credit portfolios. Auto car washes was another big one. And so thinking about that type of sector concentration and then zooming out that lens to kind of where the banking relationships lie, I think is going to be really important.
Just real quick, both of you, Winnie, let me start with you. Nothing systemic, though, yet.
No, we don't think that private credit is presenting, this existential systemic risk to the financial markets as of right now. We do think that perhaps private credit forward returns are going to look a little bit less attractive. And we do worry about some of that mismatch between kind of liquidity and what private credit structures actually look like. That could be also another kind of challenging angle. But from a broad-based financial system systemic perspective, we still feel pretty from a bank's view.
Sri, the same question to you. The sources that you speak to in the banking industry and the private credit world, do they see this as being idiosyncratic or systemic?
I think it's more, they see it more as a reflection of market sentiment right now, because if you actually look at whether it's conversations or look at some of the numbers or look at some of the public commentary, right, which is banks keep talking about a resilient economy, still a resilient economy. They worry about storms gathering on the horizon, but right now they say the consumer is resilient, the broader economy is resilient. Similarly, if you talk to the big private credit players, they look at all the loans that they're making and they will come back to you and say, look, we're running far lower than historical default rates. We're not worried about that. I think the challenge that some of the private credit players are facing is the market sentiment and increased worry about the credit sector is coming at a time when the dividend yield on some of their products is also going down, largely because lending, making loans in a floating rate is a floating rate product. And when interest rates go down, your returns will naturally go down. So when you combine the two, it sort of scares away some of the investors, and that's what's being reflected in the markets.
All right, great discussion. So exactly what we were hoping to do. Sri, thank you so much. Chief Wall Street correspondent here at Bloomberg News, Sri Natarajan, and CreditSights Global Head of Strategy, Winnie, Cisar, joining us out there from North Carolina.
Well, the U.S. Saudi Investment Forum 2025 is happening right now in Washington, D.C. Our own Annmarie Hordern is on location. She's moderating panels, conducting interviews on the sidelines of the forum. And right now, she's standing by with the Saudi Minister of Investment. Annmarie, take it away.
That's right. I'm here with the Saudi Minister of Investment, an individual who opened up the U.S. Saudi Investment Forum here in Washington, D.C., Khaled Al-Falih. Thank you so much for joining me in Washington.
Good to be with you, Annmarie. Thank you.
So let's talk about some of these commitments we've heard from the president, from the crown prince. Yesterday I was in the Oval Office. The $600 billion quickly became $1 trillion just in a matter of 60 seconds. And when you look through some of the deals that they're talking about, you hear the words commitments, MOUs. At what point do you think these deals will actually be inked, more solidified?
Well, this is actually a relationship that is quite reciprocal. Both countries benefit from co-investing with each other. There is no doubt that the American economy is the largest. The capital markets here are the deepest. I think something like 78% of the market cap of global capital markets is here in the U.S. And it's natural for an investment powerhouse like Saudi Arabia to be investing in the U.S. Also, we're modernizing, diversifying, and turbocharging our economy away, or in addition to, actually, our oil sector, which is going to continue to thrive, into new sectors where the U.S. happens to be the global leader, especially in tech and AI and healthcare and biotechnology. So I think it is natural. The capital in Saudi Arabia has been and continues to be abundant from our indigenous sources, government, PIF, companies like Aramco, which are growing their business, and they're generating from their revenue a lot of free cash flow that they need to deploy to grow and diversify their businesses. So it's natural for us to be looking at the U.S. for a majority of our future and current investment, and it's also equally compelling for U.S. investors to look at Saudi Arabia. We are one of the most dynamic and fastest growing economies in the G20, and we have many, many competitive strengths that actually make investing by American companies quite profitable and reasonably low risk, given them, the regulatory ecosystem in Saudi Arabia, the stability of the currency, which is pegged, the high credit rating, you name it. Saudi Arabia ticks all the boxes and then some. So the numbers that have been mentioned are natural, I think, given the scale of these two economies we're talking about. And they are mutually beneficial, hugely mutually beneficial.
When we first met, you were the Saudi energy minister. I used to follow you all over the world to ask you about the oil price. Where oil prices are trading right now, could Saudi continue to have that high level of investment with prices in the 60s?
Well, first of all, anybody who's been monitoring oil and oil markets like yourself would know that the market is highly cyclical. And after every downturn, there is a period of tightness because of demand being stimulated by extended long periods of low oil prices and also by throttling the investment by some countries and companies. So I expect in the mid to long term oil prices will be healthy, oil markets will continue to grow, and there will be plenty of investment. The other angle I would say is that investments in the kingdom are no longer correlated 100% with government spend, which is a function of short-term revenues from oil. That economy of Saudi Arabia has been superseded by Vision 2030. And we have, to a large degree, not fully, but we're on our way of decoupling the economy of Saudi Arabia from its strong correlation and interlock with oil prices. The private sector is the primary investor in Saudi Arabia, both domestic and international. As I said today in my opening remarks, FDI flows have quadrupled since Vision 2030 was launched in 2016, quadrupled. And as a result, our 80-year stock of FDI has doubled in the last 10 years. So in the last 10 years, we've generated more FDI stock than we had the previous 8 years. 90% of our FDI flows recently are not related to oil. It's in this, the sectors that are going to be driving the economy of Saudi Arabia tomorrow. Tourism is one example. Obviously, technology, cloud and AI, healthcare and biotech, education from the world's best universities are all coming to the kingdom and voting with their dollars and their money. So yes, oil markets will oscillate and prices will go up and down, but we don't invest on the basis of what oil prices are going to be next quarter or next year or the year after. The kingdom today is a magnet for global investment, and even Saudi investment is being reinvested at a very high place. And the kingdom, I would just end by saying, the kingdom has invested, all sectors of our economy has invested significantly, trillions of dollars abroad over the last 80, 90 years. And many investors are saying, we find the kingdom, Saudi investors, the best place to invest, and they're repatriating some of those stocks back to Saudi.
A lot of Saudi barrels, though, are going to Asia, namely China, but the dollars are coming to the United States. Do you think strategically today Saudi Arabia is closer to the U.S. than Beijing?
Well, we have actually quite a balanced global relationship economically, trade and investment. China remains to be predominantly our largest trade partner. The trade, bilateral trade between Saudi and China is equivalent to the next 4 or 5 G7 countries. So it's quite significant, and that's going to only grow because of the complementarity between our two economies. China remains to be the world factory, and they manufacture at a low cost, and we realize they're also upgrading their technology capabilities, so they are good. And I'm happy to say, as a Minister of Investment, as excited as I am here in the U.S. about attracting American investment, I'm excited about attracting Chinese investment. We think, and we've seen a significant uptick in Chinese FDI flows into Saudi. They're nowhere near where the U.S. has accumulated and continues to lead in investment in Saudi. But China is investing, and they will continue to invest. And we invest in China, too, for the reasons you mentioned. All of the barrels of hydrocarbons that go to China, we would rather process those in China in our own facilities. So both SABIC and Aramco have been and continue to invest in that world number 2 market, which is growing at a fast pace. And then we're seeing more investments in China and with China in areas where they are the global leader, especially in renewables. If you think of photovoltaics, wind energy, they're quite powerful country and economy in those sectors. And it makes a lot of sense for us to invest with them. Saudi Arabia continues to be guided by its own interests, and especially if they're aligned with countries who are like-minded and strategic partners to us. And I'm happy to say that we have that relationship both with the U.S. and China.
Khaled Al-Falih, thank you so much for your time. That, of course, was with Khaled Al-Falih, the Saudi investment minister here at the U.S. Saudi Investment Forum.
All right, Annmarie, thank you so much. Annmarie Hordern there in D.C. If you missed any of it, be sure to check out the interview at Bloomberg.com and on the Bloomberg terminal.
Hey, we are just about an hour and 12 minutes away from the close of U.S. equity trading on this Wednesday, Nvidia earnings day. Charlie Pellet has been watching everything happening very closely. Here he is for a business flash.
Thank you very much, Tim and Carol. A little change right now on the S&P 500 index. Down 6 now to 6610. Has been fluctuating, down 0.1%. The Dow swinging between gains and losses right now on the Dow, looking at a loss of 0.4%, down 186. NASDAQ higher, little changed ahead of Nvidia, up 0.1%. Our Mag 7 index up 0.3%. And Nvidia, the big story today, up now by 2% ahead of earnings. 10-year 4.12%, with the 2-year 3.59%. Gold up 0.1%, 4,073. West Texas Intermediate crude 59.43 a barrel, down 2.2%. The slump in Bitcoin continues. 88,580 right now on Bitcoin, down 4.2%. Briefly, Adobe buying the marketing software company SEMrush Holdings for $1.9 billion. Adobe down 2.1%. SEMrush up 74.3%. Again, Nvidia up 2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, gotcha, Charlie. Thank you so much. Yes, indeed. We're coming up on the last hour of trading, just about 12 minutes from now. But in the meantime, one group that we are keeping a watch on, so is Charlie, is retailers, which continue to report out their earnings. Target's lengthy slump persisted in the third quarter, underscoring the numerous obstacles that company and their incoming CEO faces, from intense competition to a weakening economy. I'm looking at Target shares down 3.6%. Tim, Lowe's really an outperformer today. It's up about 4.6%. That has its profit that topped expectations, helped by consumer spending on home renovations. And then my fave,
also Scarlett's favorite,
TJX.
She has a credit card that is just a TJX credit card.
I used to. I got rid of it.
Oh, okay.
Yeah, but like
Scarlett loves TJX.
They'll always say when you're buying, because it's always like, big stuff, like it just adds up quickly. And they're just like, you really should open a credit card because you get like 10 or 15 or 20% off the first purchase.
Okay. Well, the company posted sales last quarter above estimates and raised its outlook. And signaled that U.S. shoppers are turning to cheaper options as the economy shows signs of stress. With us right now, a Bloomberg News consumer reporter, Red Brown, and Bloomberg News specialty retail reporter, Lily Meier. They both join us here in the Bloomberg Businessweek studio. Red, I want to start with Lowe's because there was the Home Depot report yesterday that I think had a lot of people concerned. And the question was, okay, the lowering of guidance from Home Depot sent shares lower yesterday on concerns about consumer spending. Were we going to hear the same thing from Lowe's? We didn't.
That was kind of the expectation going in this morning, that we would you usually get copy-paste results from Lowe's. But it's interesting. I think with Lowe's, we kind of tend to forget it's a little bit of this turnaround story. So they've been really doing some of these initiatives to get their business back growing again. So they've really focused on things like their digital expansion. It seems to be gaining a lot of traction. They talked a lot about AI. I found this commentary really interesting about how it's already, their AI assistant kind of helps you shop. You ask what you're looking for. It's already getting 1 million queries a month. Wow. And they say it doubles the conversion rate. So it seems like they're making really good progress there. And another thing that they're doing to kind of copy Home Depot is expand their offerings to professional contractors. And that also seems to be really gaining traction. They had around $9 billion acquisition last quarter to kind of build out that business a little more. So it just seems like the divergence here with Lowe's and Home Depot is that Lowe's is just making really steady progress on executing some of these strategies, borrowing a lot of Home Depot's businesses, but doing it maybe a little bit, at least the appearance is maybe doing it a little bit better than Home Depot at the moment.
I will say Lowe's is still down on the year, about 7% to the downside. Home Depot, though, is down about 14% so far here in 2025. Hey, Lily, I want to go to TJX because it did hit, I think, a 52-week high in today's session. It's up 21% year to date, but right now the stock's little change, a little bit lower. a bit of a range, like more than a 4% range from peak to trough today. So what's going on at TJX? Although I should be able to tell everybody what's going on at TJX.
I mean, TJX is an interesting story today.
it.
You know, it really shows that consumers are looking for value. They want to get popular brands, they want to get designer brands, but they don't want to spend the premium that comes with a lot of other retailers.
And I also love like the whole TJ Maxx. I don't know how much you guys spend in TJ Maxx.
I've never been there.
On occasion.
I know. I don't know if it's a regional thing. Like I didn't have one where I was growing up. But
In California?
Well, where I'm from in California. I mean, it's a big state, but like, no, we had like we didn't have TJX. Maybe we do now.
Well, there's this like discovery factor,
From a small
right?
town.
Like if you see something, like people always say, buy it because it won't be there next time around.
Why do people love TJX so much? Why is Scarlett talking about her credit card? Mary Ross Gilbert from Bloomberg Intelligence, she said the same thing earlier on Bloomberg Intelligence radio. She loves it too.
Yeah.
Why do people love it?
Well, I think people love the like thrill of the hunt experience of going into a TJ Maxx, not knowing what they're going to find, finding something from an expensive brand that maybe normally they wouldn't buy, or that's just much, much cheaper than they would find at another retailer. So I think it's a mix of the value, like you get really good deals and, you know, you have that experience of not knowing what you're going to get.
I forgot too that you do get a discount when you open, but you get coupons for when you spend. So like you have like a $5 coupon or a $10 coupon. So it's like,
it's the hunt, the bargain.
I was like, honey,
It's
I
the
have a
hunt.
coupon. And they're like, yeah, but you're still paying for stuff. Let's go to Target. What do we see with Target here, Red?
Yeah, Target continuing this slow kind of decline. They're still kind of struggling through another kind of turnaround story similar to Lowe's, but it doesn't seem to be executing as well. Sales were down 2.7%. For the quarter. It's been 3 consecutive quarters now of falling sales. I think with just to bring TJ Maxx back in, because it is our favorite topic here at the moment.
There's also home goods too, where you can buy all the pillows you want.
Correct, right? So with Target used to have that sort of like fun surprise factor.
So true.
Right? And it seems like they've sort of lost their way a little bit there. And I think that maybe is still kind of reflected in some of the results. They've tried to move into things like grocery, but they're just not able to kind of compete in the way that Walmart is there, just in terms of scale. So it's still kind of remains to be seen where Target can kind of reinvigorate that growth, can reinvigorate some of that excitement that they used to have.
Can I just say, Target, what they used to be known for and used to do it so well is they had these collaborations with Isaac Mizrahi, Alexander McQueen, Missoni. I mean, I remember people lining up before the store opened. I was like, when are they, going to bring out the collection? And people would just, go there and buy tons and tons of stuff. Like they just were kind of cool in how they did that kind of stuff.
Yeah. And that's kind of the new CEO's priority. He really wants, when he comes in February, he really wants to be able to bring fun back to Target and bring that kind of excitement back.
Yeah. As people who watch and listen to our program regularly know, we're trying to figure out where this economy is, where the consumer fits into this economy. We're going to hear from Gap later this week. We get Walmart earnings later this week as well. That will certainly shed a light. But Lily, ahead of that, thus far, what we've heard from these retailers, what's the picture that they're painting the consumer?
I mean, I think we know the consumer is pretty stressed. I think they're stressed, but they're still spending. A lot of the companies I cover, so those specialty retailers, so like a Gap or Victoria's Secret, haven't reported yet. So I think that will be really interesting and kind of rounding out the picture, especially around what young consumers are doing.
You cover Crocs. That was a very hot company for a long time.
Yeah.
It's had some troubles lately.
It's had some troubles lately.
Is that because of the consumer or is it because of Crocs?
It seems like a mixed story there. Yeah, I think they saw some people pulling back, and I also think they've kind of struggled to get people excited.
Yeah, Red, come on back in here, because I do think, that's one of the things we are trying to figure out how the consumer's doing, and not every consumer is the same. And again, we do talk about a wealthier consumer has seemed to continue to spend. Are you picking up on any kind of narratives or threads? Especially, I always feel like on the call with analysts or investors, that's where you start to get some better color about what's going on.
Yeah, definitely. I think it's interesting. Like I feel like some of the sentiments that Lily said are being echoed across like Lowe's, Home Depot as well, where like there is this idea of still the resilient consumer. Like I feel like we heard that a few quarters ago. Like consumers are still resilient. We heard this also in restaurants a couple of weeks ago of these richer consumers are also trading down into fast food, things like that. So it's like people are managing, right? But it's just like they're doing it in these sort of like interesting ways. Like we all are kind of feeling these same pressures that we're talking about. We can all have real life examples, but it's still like it's still like I don't feel like we can't like make a definitive call yet to say the consumer is weak, right?
Well, let's not forget, right? The big behemoth that we get is Walmart, and we get that I think on Friday, correct? In terms of their earnings, they report on November 20th. So tomorrow, forgive me. So tomorrow before the open, and that's one that we watch because that certainly hits a certain economic strata. So Lily, what are you watching out for from Walmart?
I mean, I don't cover Walmart directly, but I think it'll be interesting to see the similar themes. So like, what are consumers spending on? How much are they spending? Are higher income consumers trading down, which we've heard a little bit over the past few quarters. And then more broadly, like, I think holiday shopping will also be a really good indicator of what the consumer is doing and how they're feeling.
Well, that's a really good point. What have you been hearing, Red, in terms of any of the, I don't know, it's not like you're going to buy like a 2x4 for like somebody for Christmas. Although,
hey, actually, a lot of the home, I like not necessarily 2x4, but maybe that.
You would love that.
That home improvement appliance or that tool that you've got on your shopping list that you haven't really bought yourself. That's always a good gift.
There is stuff.
I will say one thing, just from Lowe's today, they did call out that like their appliances and sort of these like like gift type options are like they actually did see pretty solid growth there. So maybe I don't know, it could be a thing if people are spending now to like get ahead of these things. I mean, Black Friday will obviously be the big discount day. We'll get a ton of insight into how the consumer is feeling, but I guess it will. It's tough to kind of tease out still. So I think people are shopping. So people still want to get those nice gifts, those 2x4s for their friends and families.
Some nails.
Maybe
sure.
Coal, do they sell coal at Home Depot, Carol?
I just got coal from my family.
Rude.
1 year. Can I just tell you, every time I go into a TJ Maxx or a Home Goods, packed. They're always busy. That stocks up to almost 21% year to date.
Lily, before we let you go, your view on the holidays from the companies that you cover. Certainly Gap we'll hear from later this week.
Yeah, and more broadly, we had a story come out, I think last week, about how a lot of retailers are pulling back on deals. So this Black Friday might be less promotional in the past, which is complicated for consumers who are looking for deals more than ever.
I don't know. I did walk over to Fifth Avenue earlier today to run an errand and walk by all those. Did not buy anything, but all those retailers over there.
What?
They're in full holiday mode.
I know.
I heard the bells ringing and everything already.
I know.
It's not even Thanksgiving yet.
It's out and about. It's happening, guys. Lily Meier, thank you so much. Specialty retail reporter at Bloomberg News, and of course, consumer reporter at Bloomberg News, Red Brown. Good to have you both here. And we'll be keeping a watch on some of the other retailers to report later on this week. Hey, that's going to do it for the first hour of Bloomberg Businessweek Daily. Carol Massar along with Tim Stenovec. The close coming your way on TV. Bumping along the bottom, slightly higher in the S&P, about 60 points higher in the NASDAQ 100. Nvidia's up ahead of earnings.
We're going all in on Nvidia. We got CFRA's Angelo Zeno. We've got Bloomberg Intelligence Senior Semiconductor Analyst Kunjan Sobhani, and more.